The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. This is Chris Kopak, Assistant Vice President of Facilities at the University of Arizona, also the Media Past President of APA. And we're continuing on with our continuous learning model of our webinars, monthly webinars that have just been a huge, huge success. A lot of great information that our members giving back to our members so they can take that back to the universities to be more effective, be more efficient, and hopefully drive down cost. We sure appreciate the staff at APA for assisting coordinating these, Billy, and everybody else behind the scenes. We also wanted to mention, too, with our webinars that APA has revamped the entire web page, and we have a calendar of the webinars for future months. So feel free to take a look at those. The webinar also will be on there in terms of the audio and the PDF of the PowerPoint. And with all that said, we have a great presentation today. Andy Hunenfeld, Director of Price Risk Management at Kinect Energy Group. And Andy has shared his knowledge in the past. I know a number of our members, natural gas is a huge, huge utility expense. And if we can be more efficient in that volatile market, that's what we're going to be talking about today. So Andy's going to talk about managing risk and taking advantage of opportunities in the volatile natural gas market. Always a very interesting topic for our folks who are dealing with our utilities at our universities and colleges. We will have about a 45 minute presentation. We'll be taking questions throughout the presentation, so feel free to go ahead and send those to me. And then we'll have about 10-15 minutes at the end of the presentation to go ahead and answer any burning question. So with that all said, Andy, I want to thank you because you've helped in the past on these webinars, sharing great information, usually around September, October, when the natural gas market is changing. We thought it'd be great with what's going on with the world economy now to have you in. So take away, Andy, and thank you very much for your knowledge and your support of APA.
Absolutely. Thank you, Chris. And thanks, everybody, for joining. Just really quickly, throughout this presentation, the focus is going to be on natural gas, but wanted to make clear at the beginning that natural gas is also, along with weather, the #1 driver of electricity prices as well. So when we talk about downside opportunity or upside risk in the gas market, that's also going to translate to your electricity costs, especially for those of you located in deregulated power markets across the country. But also, before we get into the market stuff, some quick disclaimers. One, energy markets are inherently kind of unpredictable. We try our best, and we think that we're pretty good at getting a sense of the pulse of the natural gas and power markets across the U.S., but there are a lot of external factors that are totally unpredictable that drive these prices, and that really highlights the importance of establishing, maintaining, and adhering to a risk management strategy. And that's one of the primary functions that we help our clients with is kind of talking to the business, or in this case, university, and getting an idea of how important things like long-term budgeting are, or price certainty when it comes to this major expense on your budget. Once we have that information, we can work with you, the stakeholders, and develop a plan to make sure that you're in the best position to take advantage of market opportunities and to avoid the risks associated with these unpredictable and fluctuating and oftentimes very volatile energy prices. It's all about kind of striking that appropriate balance between leaving yourself open to take advantage of future opportunities and establishing that price certainty over time. And that's something that we help a lot of our clients with. And universities, we do work with a lot of universities, are in a very unique position because in a lot of cases, compared to, say, an industrial facility that also uses a lot of energy, you have a lot more long-term certainty. You've got the ability to do a lot more long-term capital planning. And that, especially in this current market, which we'll talk about, definitely puts you in a unique position to be able to take advantage of the opportunities that are out there. So with that said, we'll get into kind of what's happening right now across the U.S. in the energy markets. And we are going to start with a broad focus, talking about some of the macro drivers that impact prices across the entire country. And then we'll spend a little bit of time at the end highlighting some regional factors and specifically kind of drilling in on the Western United States, because that's where we've seen a lot of the most interesting and most volatile price action over the past 12 months. So a quick summary of what we see in the market right now. Typically from the spring, when energy consumption is at its lowest, you do tend to see pricing rally into the summer. And we haven't really seen this materialize just yet. We've had somewhat of a slow start to summer cooling load across a lot of the country, and that's helped to keep a lid on pricing and largely keep the market on the mat. We do still, looking back, feel strongly that we traded a seasonal bottom back in April, potentially a major bottom for energy prices back in April, but so far we have not seen any sort of a major seasonal rally materialize. Storage inventories, which we'll talk a lot about, are always a big concern for the gas market. Basically, we spend the summer building up storage underground across the country so we can use that natural gas over the course of the winter when demand on a daily basis outpaces supply. Inventories are improved from where they were coming into the winter, which we'll get to, but still lower than average, so that is still a concern. Domestic production growth, meanwhile, which was very rapid throughout most of 2018, has been flat now for about 6 or 7 months. That's a big concern as we move through the year, and we'll get to some of the reasons why. But primarily those reasons are the U.S. is exporting more natural gas than ever. We're seeing those exports grow almost on a monthly basis right now. That keeps pressure on prices. We're burning more gas than ever for power generation purposes, and we've seen ongoing increases in the amount of gas that's being burned by the industrial sector, really dating back to the recession in 2009. So we're working on a decade now of consistent growth and that type of consumption, and we do expect that to continue in 2019 and beyond. So there's a lot of pressure from the demand side. Supply gets most of the headlines with the big increase in domestic production since the onset of hydraulic fracturing and the shale revolution, as we call it. But in reality, demand and consumption of natural gas is very much keeping up with production growth, and in a lot of cases, including 2018, outpacing domestic production growth, which is pretty impressive. So speaking of 2018, on the next slide, you can see we did produce a record volume of natural gas in the United States last year. And not only did we break that record, we broke it by about 10%, dating back to 2015. So produced on average for the year about 81 billion cubic feet per day, by far the largest volumes ever across the nation. However, even though we're producing all of this new gas, storage inventories, which I mentioned earlier are a very important driver of price, we're actually at a 16-year low going into last winter, just about 3.2 trillion cubic feet, by far the lowest of the previous 5 years. And that's kind of a head scratcher for a lot of people. How are we producing all of this gas, unprecedented volumes, yet we didn't even stock up healthy levels going into the winter? And really the reason comes down to demand. And alluded to this a few minutes ago, but we saw so much of an increase in consumption from multiple sectors across the board that excess gas that we were producing was not available to stock away for the winter. And instead it was going into combined cycle generation turbines or going to industrial facilities helping to make fertilizer or being exported via liquefied natural gas. So this is one of the consequences of that increased demand, is that even though we produced far and away the most gas ever last year, we still couldn't even muster healthy inventories going into the winter season. It was the lowest since 2003, and in 2003 we were producing about 30 billion cubic feet less of natural gas per day than we did in 2018. So even though we've seen all of that increase in supply, storage inventories really suffered last year, and it led to a lot of consequences. We saw tremendous market volatility going into the winter. We saw benchmark NYMEX natural gas up as high as $5 per MMBTU in November as the market kind of entered into a panic mode, wondering whether or not we had enough gas to meet winter demand. Thankfully for end users, we got a stretch of about 6 weeks of very mild weather across the country from mid-December through, or early December through mid-January, and that helped inventories recover and kind of took some of that volatility out of the marketplace. But last November was a very, very stark and very real reminder across the nation that you can't be complacent about energy prices in this environment. There's so much made of how healthy supply is that it's easy to do so, but with the growth that we're seeing in demand and the ongoing growth that we're expecting in demand, this is still a market that is very laden with risk, and we do see that continuing in subsequent years. So looking out at pricing over the next 4.5 years, the second half of 19 and then through 2023, we have an unprecedented opportunity right now. And this isn't necessarily anything new. The forward curve has looked like this for about 1.5 to 2 years. But overall, when we look at the long term right now, and I think this is especially important for universities looking to do long-term capital planning, we've got an opportunity to not only buy natural gas very close to what we've seen as kind of a demonstrated floor. If you look back at 2016, that was the perfect storm for low pricing. We actually saw a collapse basically due to a winter that didn't show up during the first half of that year, where prices briefly got down below $2 per MMBTU. And we saw what consequences that brought. Number one, and most importantly, it was no longer economic to produce natural gas at those types of pricing in most parts of the country. So we started to see production volumes fall, and they fell for 2 years after that. So that showed the marketplace, okay, this is too low for pricing. Once we get down here, we can no longer expect supply growth, and in fact, we might start to see supply contraction with producers going bankrupt at price levels like we saw during the first half of 2016. We also saw that year every generator that had the ability to consume natural gas, whether that's an inefficient generator that was built for peaking purposes or one of the new crop of generators built for baseload purposes, was operating as much as physically possible, sucking up that cheap gas and increasing consumption and normalizing the market throughout the year. So in short, not to spend too much time on 2016, but I do think it's an important test case for kind of the floor for the market. How low can prices get, and most importantly, stay? And that year, the annual average for NYMEX natural gas settlements was $2.46. So we've got maybe a couple of dimes in some of these calendar years to move lower. Compared to even just recently in 2017 and 2018, which weren't incredibly bullish years, but kind of in between, and we averaged over $3 per MMBTU. So looking out, our view is that long-term downside opportunity is limited, upside risk is a lot more exaggerated. And we are encouraging our clients right now to take advantage of this. Of course, again, within the confines and the context of an established risk management plan that outlines what you're able to do and why you're doing it in order to kind of lock these positions in and establish this type of price certainty for the long term. The other unique part about this market is that the forward curve is what we call backwardated, meaning that you can actually buy natural gas in a lot of places right now for cheaper in 2021 than you can in 2020, and cheaper in 2020 than you can for the balance of 2019. And this is not a normal futures market. Typically, you see a contango where there's a risk premium built into the future. Right now, there's a risk discount. The market's pricing in abundance. It's pricing in the best case scenario going forward. If that scenario doesn't play out, as we've seen as recently as last year when storage inventories were at 15-year lows, there's a lot more room for these to come up to the upside. So again, love the long-term value in the market right now, and love the opportunity for end users, especially institutions like universities.
Hey, Andy, this is Chris. We're getting a lot of great questions come in. It seems like you got a contradiction, though. We're coming out of the winter months where the production or the storage levels were very low. affecting price, but you're saying we can go out 5 years and buy it at $2.71. And so that seems like what a great opportunity to be a little more conservative with our utility purchases.
Yes, absolutely. So what we've seen with the market is that it's very, I guess, I don't want to use the word finicky, but very over-responsive to kind of the here and now. So when we saw that volatility happen last fall, it was very much focused near the front of the forward curve, while these deferred contracts stayed pretty stable. We didn't see much movement at all out across the curve. So what we've seen is as these months and as these years get closer to the forefront, closer to the present, that's when they get on the radar of a lot more market participants, and that's when we see volatility really picking up. So that is, again, another reason to go out a little bit longer term and take advantage before you start to really see some of that volatility set in.
There's a question from John that has come in here, and it's talking about California. And is California's decision not to store natural gas a factor in the storage being the lowest since 2003?
Not really. That's been a major impact on California's specific energy prices. But in the grand scheme, on a nationwide basis, the western region represents a very small percentage of overall storage. So yeah, it plays into it, but it was not by any means the primary driver of those low inventories.
And if we're producing more natural gas now, but we're exporting it at a higher rate, what countries are we sending it to, knowing that we have some challenges going on with tariffs right now?
We will get to that later in the deck. I've got a whole section about exports, and we'll look at where those exports are going and specifically kind of what the trade war with China could potentially do to those exports.
Okay. And just for clarity, too, we're getting a little echoing on your end, Andy, so just be aware of that.
Okay. And I'm hearing it a little bit, Chris, on your, when I think if you stay muted, it might change it, but I'm not sure.
I'll go ahead and stay muted. Go ahead.
Okay. Moving forward, and this is just an illustration of kind of the volatility that we saw last winter and how much things have settled down recently. We've been in a pretty tight range since the beginning of May, and really since the beginning of the spring and summer. But still not too far in the rear view was all of this crazy price action, all this volatility that was primarily driven by those low storage inventories. And we might be headed to a similar situation this fall. And that's why I think there's somewhat of a sense of urgency while prices are still low, especially for next winter, to be taking advantage of that. So storage levels have improved for sure, and they've improved even more following this morning's report, which showed another very large build into underground inventories. But we're still not even equal with the 5-year average. And when we project supply and demand out for the rest of the summer, assuming mostly normal weather, we still see a scenario where storage is still below the 5-year average by the time we get into the winter. And we'll show with increased consumption, increased exports expected next winter, we frankly need more gas in storage to be able to meet that baseline demand over the course of the season. So even if we are more healthy than 2018, which we expect to be, how much more healthy is important, and whether or not the market will view that as enough gas going into a winter season with unprecedented exports and unprecedented baseload consumption of natural gas, where we have seen steady increases in demand almost every winter on a weather normalized basis. So I don't want to spend too much time on the weather, but it is important since it does dictate a lot of that summer consumption. This is the most recent June through August weather forecast. And this is from a firm called WSI Trader that's owned by the weather company that's now owned by IBM. And this is one of the outlets that we look at, and one of the kind of more prevalent outlets across the marketplace. And it is unique right now. And I think this is one of the reasons that prices have not establish much of a seasonal rally. We're not calling for a hot summer for the first time in a while. A lot of forecasting outlets are looking at a more tame season with a distinct cooler than normal risk across a large percentage of the United States, including Texas, which is a very important state during the summer that drives overall natural gas consumption, because Texas, as everybody knows, has the ability to get extremely hot. A lot of air conditioning load in that state, and they lean heavily on gas generation to meet that air conditioning load. So if Texas stays normal to even slightly cooler than normal as dictated by this, it could reduce the risk as the year goes on for prices to go higher. We do still expect warmer than normal temperatures along the coasts. I mean, you look at this on a population-weighted basis, it's about 7% hotter than normal, looking at cooling degree days, but actually almost 10% cooler than last year. So kind of a mixed bag this summer, but the caveat here with any longer-term weather forecast is that this can and will change as the weeks go by, and these forecasts, as everybody knows, are historically inaccurate. So this, right now, the market's looking at this as a maybe less risky summer than we would normally see, but that could really change at the drop of a hat as we push forward into the season. So wanted to talk about some key supply and demand factors. And the most key in recent years and over the past decade has been domestic production. This is a 2-year snapshot of production growth. But if you extend this back 8 years before this even, we've seen these volumes grow from around 55 BCF per day 10 years ago to as high as 87 or 88 BCF per day in recent weeks. That's a major increase in supply. It's totally changed the way we think about energy in the United States. It's paved the way to become a net exporter and led to a lot of very low prices for end users across the country and opened the door for a lot of economic development. So this is the single most important factor in the energy market over the past decade. I do not want to downplay this. But when we look at risks in the marketplace, we really start to look at the last 6 months in which we have not seen much in the way of production growth. We're almost on a plateau right now, and there's a number of factors driving this. We're limited in pipeline capacity in several key parts of the country for now that are kind of stymieing the ability for producers to expand operations. But the reality is that after about 11 months in 2018 of very rapid growth, we've now seen 6 months of production bouncing back and forth between 85 and 87 BCF per day. And right now, this isn't a big deal because we still have this nice cushion over last year to absorb some of the year-over-year increase in demand that we'll talk about. But next winter, late third, early fourth quarter is where this could come to a head. If we're producing about the same as we did last year throughout the course of the winter, but we're, say on the next slide, we'll look at consuming more from generation, from the industrial sector, and then to a greater degree exporting more gas than ever. That means we need more gas in storage. And that's why storage becomes very important and why we still do have some concerns about expected inventory levels going into the winter season. So real quick, before we move on to the next slide, I do want to show the changing generation mix in the United States. We've seen natural gas go from 10 years ago, less than a quarter of overall power production, to more than 35% of every megawatt hour generated in 2018, actually overtaking coal in 17 and 18 for the first time on record. Renewable growth has been prevalent as well. We've seen that more than double over the past decade, but that still represents a relatively small share of the overall mix. The rest of the mix, besides renewables, and mostly that 10% is wind and solar, natural gas and coal is pretty stagnant. You've got nuclear down there that's about 20%. You've got some hydroelectric, small amount of petroleum, things like that, but no major long-term trends. That's why this chart starts at 25%. But the big shift has been natural gas and to a lesser degree renewables really eating into coal's share of the marketplace. And this does A few things. One, it increases consumption of natural gas. So the graph on the right here shows the increase from about 18 BCF per day in 2008 to recent levels as high as 30 BCF per day. So that's a gigantic change in the way that natural gas is consumed in the United States. But it also, to one of my earlier points, more closely ties natural gas pricing to power pricing. And that's something that's always been the case, at least from a marginal standpoint, where natural gas is responsible for a lot of peak power demand and peak power generation. So it helps set the price on the margin. But as this share in the generation mix continues to grow, it becomes more all-encompassing. And not only is gas setting the marginal price of power, it's also in a lot of cases setting the baseline price of power. So that ties all of our energy costs together even more than it ever has been. So in 2019, based on the build out of new natural gas-fired generation capacity that we've seen since last year, we expect about a BCF and a half, 1.5 BCF per day of additional demand that we didn't have online in 2018. So that's gas that last year we could have injected into storage. This year, it's going into a combined cycle turbine for power generation. Meanwhile, we have this slow march higher in industrial demand, and we expect that to continue in 19 and going forward, assuming we don't see any sort of a significant economic downturn, and that increases consumption by about a half of a BCF per day in 2019 compared to 2018. But the most stark change that we can expect compared to last year is this acceleration of net exports. We're importing less than we ever have from Canada. We're exporting more than we ever have via pipeline to Mexico. And we're watching as a large build out of liquefied natural gas export capacity comes online along the Gulf Coast and to a lesser extent along the East Coast of the United States. Conservatively, when we look at all of these factors in 19 compared to 18, we anticipate an average of about 4 billion cubic feet per day of additional volume leaving the U.S. that stayed here last year. And that's a big deal. And this is why when we get into the winter, we need a bigger cushion of gas to sit on to avoid any sort of shortfalls as the season progresses. The winter is roughly 150 days, the natural gas winter, I should say. And over the course of that 150 days, if we're exporting 4 BCF every day that we did not export the previous year, that's 600 billion cubic feet over the course of the season that needs to be in storage that wasn't there in 2018. And that assumes the same weather plays out. And last year we did have some cold stretches the winter, but overall it was a pretty mild season. So if we were to get a cold winter overall in the U.S., combined with all of this new export demand, combined with the structural demand we talked about on the last slide, we could be in for some trouble. And right now the forward curve is not pricing in that risk. And that's why I think it's prudent to get out ahead of that until things maybe come to a head and drive prices dramatically higher this year. So the LNG export story, and this is a big deal in the U.S. This is the biggest kind of sea change outside of the proliferation of hydraulic fracturing that we've seen in our country. Dating back to 2015, the U.S. had zero capacity to import liquefied natural gas. In fact, we still have the capacity to import about 14 to 17 BCF per day of liquefied natural gas. It was not that long ago when conventional wisdom said we're running out of energy in the U.S. and we're going to be relying on imports from here on out. So you saw hundreds of millions or billions of dollars in capital invested into import facilities, able to take in cargoes from other countries to regasify and put into our pipeline system. About the time that most of that capacity was finished construction was when we realized, hey, not only are we not running out of natural gas, we have more than we know what to do with, and production is expected to grow for the foreseeable future. So you saw all of that capacity basically sitting idle, and a lot of those terminals have made moves to convert their import capacity to export capacity. And that's 4 of these 5 major export facilities that are either operational or under construction. Used to be import terminals. They've retrofitted the facility, and added liquefaction capacity. We're just at the beginning though. So we have 2 more major large-scale facilities along the Gulf Coast, one in Louisiana, one in Texas, that are expected to start coming online this year. We've recently seen LNG exports reach as high as 6 billion cubic feet per day. This has the chance to get up to 9 or 10 BCF per day. It says by the end of 2020, but more realistically, a lot of this is expected to be online by the first half or even first quarter of 2020. So this is coming up, and this is a big driver of risk, in my opinion, and a big driver of demand that connects us closer to the global market and increases the uncertainty in our energy prices going forward. And then Chris asked a question earlier, and this is a question I've been getting a lot from clients that we talk to about this stuff. What to make of the trade war with China? What impact will this have, has this had, and could it have in the future on our energy at home and our liquefied natural gas exports? So this shows 2018. The U.S. exported natural gas to liquefied natural gas to 30 nations across the world. China was the 4th largest importer of U.S. sourced LNG in 2018, accounting for about 8% of total export volumes, about 1/4 of a BCF per day. So I want to focus on a couple of things here. First, that volume is not insignificant, but it's not terribly significant either. Over the course of a year, if all of that gas stopped leaving our coast, that would be equal to about one mild winter day worth of demand. So not insignificant, but also not terribly significant. But the most important aspect to keep in mind when you see headlines about China imposing tariffs on U.S. LNG is that we have a lot of flexibility with where this gas goes. The long-term contracts that all of those export facilities were built on, the vast majority of that capacity is tied to destination flexible agreement, meaning that it's not one country or bust. We can find the best market for this gas and find underserved markets where the price is right. So what we've seen in 2019, and we've got 3 months worth of data from the DOE, is that China largely has ceased importing U.S. sourced natural gas. They've cut their imports in about 1/3 compared to average volumes in 2018. But that has not had an impact on overall send-out. In fact, as new capacity has come online, it's been fully utilized, and we have not seen any major disruptions in our exports because of that destination flexibility, and because if China doesn't want our gas, somebody else does. Where this does potentially have an impact, I don't want to totally downplay it, is in the longer term. So behind these facilities that we see here that are under construction, where operation is imminent, there are 5 more facilities that have full government approval, full regulatory approval to start construction tomorrow if they want to. A lot of those facilities are having trouble getting the same types of contracts that were the basis of the investment in the construction of the terminals that we're looking at on the screen right now. So they're looking at more individual off-takers, and in a lot of cases looking toward China to speak for some of these volumes. With the future of trade with China very much up in the air at this point, some of those second wave of facilities are on hold. So this isn't necessarily a near or medium term driver, but it could be a long-term driver and perhaps delay the next wave of export capacity that might otherwise come online in 2023 or 2024 after a long construction process, might kick that back a year or so, or at least until we get a little bit more long-term certainty about our trading relationship with China. I'll stop right now and see if there's any questions about that, since I know that has been an item that's been in the news a lot in recent weeks.
You know, we have a question here from Nicholas. And how large is China's daily demand for gas? You've addressed that. What percentage of natural gas is imported from the United States? So you have addressed that. So you already knew what they were thinking. But can you talk about Mexico? Mexico is getting some of our natural gas from us. What is Mexico's plans to improve their infrastructure? And where do you see not only Mexico, but all the countries there that are great possibilities for future growth for the U.S.?
So to address the first part, I don't have the data as far as China's overall natural gas consumption or demand, or even what percentage of that is met by the U.S. That data is available. Typically, the U.S. is kind of a leader in publicly available energy data. The EIA does a great job of putting that out on a timely basis. So I'd have to dig up some research papers or something like that to fully answer that first part of the question. Don't have that in front of me. I suspect it's a very small portion of China's overall consumption, though. As far as Mexico goes, Chris, that's a kind of a mess right now. The constitutional amendment that was passed in 2014 to open up the energy markets to third-party participation did change the game. It broke up the Pemex monopoly for the most part, and generally increased consumption of natural gas in Mexico, with the goal of part of the goal of the amendment was to increase production, and that has not happened yet. I'm not sure it's going to. So the consequence there is that as consumption ramps up, as they lean more heavily on gas for generation, as you see more manufacturing facilities open in Mexico, their production's falling, the U.S. is being called upon to make up that gap. And there is a lag, as you mentioned, in distribution infrastructure that we don't know when is going to be made up. The U.S. used to export about a half of a BCF per day to Mexico. Now we export about 5 BCF per day. So we've already seen those exports increase by tenfold. We expect it to continue to trend higher, but there was a new administration that came in December that has altered that landscape a little bit and cast some shadow of doubt over the future. Essentially, they're trying to take back state control of a lot of pipeline projects and a lot of pipeline capacity, and that has muddied the waters some. There's a new pipeline expected online in June that goes actually underwater through the Gulf of Mexico. That could lead to some additional send out, maybe even displace some of the LNG export demand that we've seen from Mexico. But overall, the name of the game with Mexico is uncertainty. We expect to export more as the years go on, but that's a lot less of a probability than it was even 12 months ago under the previous administration.
Where will that line daylight that you said is going underneath the Gulf of Mexico?
So where what?
Where is it going to end up in Mexico if it's going through the Gulf?
So it'll end up kind of on the southern peninsula, and that's an underserved part of the country right now because of some of the delays in distribution infrastructure from the coast. So right now, the reach of U.S. gas is kind of limited as far as how far south they can penetrate down into the country. And that's why they've been importing a lot of LNG, not only from the U.S., but also from other countries. But this pipeline is expected to meet some of that demand that was previously met by LNG with pipeline gas from the U.S. Gulf Coast.
Hey, before you go off this slide, too, we have another question that came in from Nina Bisbee. And she's asking about where is the gas shipping out of the Gulf coming from? It's a two-part question. And how much are these trends differing regionally?
So largely, it is coming from the Gulf Coast. Right now, there's very limited spare pipeline capacity that is available to bring natural gas from West Texas, which has been a big hotbed for new production, which we'll talk about here in a little bit, toward the Gulf Coast. There are some projects underway that are expected to help solve that by the end of the year, and a lot of the LNG export demand might be met by West Texas production. And there's also been a lot of new flows available coming down into the southeast from the Appalachian region, from the Marcellus and the Utica shales in Pennsylvania, West Virginia, and Ohio, that are making their way to the Gulf Coast via some new pipeline infrastructure. So the answer is kind of from all over the place, but primarily from that Gulf Coast area with a little help from other parts of the U.S. And then what was the second part of the question?
The second part was, and how much are these trends differing regionally?
So quite a bit. We're seeing a wide variation in pricing across the United States. And that's actually a good segue kind of to the end of the next section of the presentation, which we'll get to. But we've got a situation where in an extreme scenario, during the first quarter of this year, we had pricing in Washington and Oregon as high as $160 per MMBTU for a day. Meanwhile, in the Southwest and Texas, they're giving gas away for free or actually paying people to take it off of the system. So the way that our pipeline infrastructure works in the U.S., there is a wide range of regional markets with very unique drivers in each part of the country, and we'll get to some of those here in a couple of slides.
Excellent. And if they are giving it away free, we need to talk after this call, but we'll save that for later. What about India? I don't see them on your list here. And if we're talking future growth throughout the world, India, China, 10, 20, 30, 40 years down the road, where are they getting their gas from?
So India in 2018 was the 5th largest importer of U.S. natural gas, just behind China. The way that some of these cargoes work, it's not, we express it in BCF per day, but it's not a consistent flow. These are large ships that are making a handful of deliveries over the course of a few months. So we do not have any recorded exports to India during the first quarter, but I would assume that once we get a full year of data, that'll pop back up on the radar here. I'm not sure what India's capacity to import is or anything like that, but I do anticipate that to be an ongoing outlet for U.S. source natural gas.
Excellent. Thank you.
Yep. So taking a little bit of a step back and looking at this year, right now we're projecting about 3.6 trillion cubic feet in storage going into the winter. This could change, and actually with some data that we saw today from the government, we saw a very large, unexpectedly large build into inventories that might alter this trajectory a little bit. But largely we do expect storage to be in better shape than last year, but still probably in line or even below the 5-year average going into the winter. Mentioned earlier that we might need about 600 BCF of additional gas this winter for exports than we needed last year, especially if production is relatively flat still going into next winter. And that means that this cushion that looks like we are in a lot better shape than we were in 2018 might not be as good as it looks on the surface because of all that additional demand that we expect online from exporters next winter. So this shows a storage-wise in a vacuum does show a better picture that might help avoid some of that volatility that we had going into last winter. But in reality, when you look at the big picture, perhaps not. Perhaps this is not a healthy level going into the winter, and we'll see how the market responds to that as we get closer to that season and as 2019 progresses. And we already looked at this, but just as kind of a bookend to the market presentation, even with all of these risks that we see, the near and medium term with increased exports, increased consumption, we still have low prices across the board. And you can take this as a couple of different things. I look at it as the market pricing in ongoing and very robust production growth. I don't think that that's a guarantee. And if it stops showing up, like it has for the past 6 months, if that continues, or especially if we were to see an unexpected downturn due to some of these low prices, then it could shock some of these deferred years back up to a premium. So again, we are encouraging our clients to take advantage of this backwardated forward curve and of this long-term discount while it's still available. So the question about a regional specific, and we don't have time to do a deep dive into all of these parts of the country, but I do want to go, I do want to go into at least a surface level discussion about what we see across various parts of the U.S. Starting on the East Coast, especially in New England, we're still seeing prices stay elevated, especially for winter months, because of the lack of significant pipeline infrastructure coming out of the Marcellus Shale. There's been a lot of increased flows west from the Marcellus and south from the Marcellus, but most of the pipelines that have been proposed to go up into New England, into the Boston area, have run into a lot of environmental roadblocks. So right now the market's on a forward basis are not pricing in any significant increases to infrastructure, and you do still see an elevated risk along the East Coast, even though the proximity to that Appalachian and Mid-Atlantic supply is so close. The Gulf Coast, LNG exports and send out to Mexico have kept the Gulf Coast pricing actually some of the highest in the country, kind of ironically, since historically that was the baseline, and most parts of the U.S. traded at a premium. Now, for especially summer months, most parts of the U.S. traded at discount to the Gulf Coast, and that's due to declining traditional production, offshore and onshore, as well as that increased exports that are mostly sourced right there from that Gulf Coast region. The Midwest has been the beneficiary of some new pipelines flowing out of the Marcellus Shale. The Rover and Nexus pipelines are both fully up and running now. And there was an idea, and this was baked into some forward pricing for a while, that this would help eliminate winter risk. And we've seen over the past 2 years that that's not necessarily the case. We still see prices in Chicago and in Ventura and Iowa that dictate a lot of pricing throughout the rest of the region. We still saw those elevated compared to NYMEX, compared to the benchmark throughout the winter. And now that's being reflected in forward pricing, where you do have a premium that you have to pay to buy natural gas in the Midwest if you want to lock in future winters. And I think that's logical. We've got new supply and a better diversity of supply, but it certainly does not eliminate winter risk in a part of the country that has the ability to get extremely cold and really lead to some constraints on existing infrastructure throughout the course of the winter season. Things get a little more interesting as you go out west. In the Rockies, there's a lot of stranded natural gas, and prices are low and expected to remain relatively low. In the Southwest, you take that idea to the extreme. What we've seen in West Texas, in the Permian Basin specifically, is a major increase in the amount of crude oil production over the past 2 or 3 years. Crude oil traditionally comes with associated volumes of natural gas. In fact, historically, about 15 to 20% of every MMBtu or every BCF of natural gas that's produced was sourced from a crude oil well. And what's important to note about that associated natural gas is that those producers, frankly, don't really care that much what the price of natural gas is. They're looking at the economics of crude oil, which have been very favorable and are, at least for now, for shale production. And the natural gas, whatever they can get for it, is just a bonus. So we saw that happen for a while. We increased natural gas production out of the Permian Basin to the point where there was no longer any additional capacity to continue to distribute that gas. And at least until we see some Mexican infrastructure come online, or see some of those pipelines designed to move over to the Gulf Coast come online, there's not going to be a big runway for new natural gas production growth out of the Permian Basin. And what that's done to local prices is it's pushed them down to zero, or in some cases actually turned negative. There have been days after some unexpected outages in certain parts of the infrastructure where folks were being paid as much as $4 to $6 per MMBTU if you're connected to the Waha pricing point for every decatherm that you consume. So that's definitely a unique situation. We don't expect that to spread out, because if it could spread out, then the prices wouldn't be negative. The reason that they have been negative is because there's no more room to move gas out of that system. It's being flooded with natural gas coming along with these crude oil volumes. Then as you go further up the West Coast, you start to run into some more issues. California has consistently had some of the highest pricing in the country due to the storage facility that was offline for a long time and ongoing maintenance on the SoCalGas pipeline system. That's led to a lot of volatility in delivered natural gas in Southern California, as well as delivered electricity across the state. And we expect that to continue. The Northwest, we saw a pipeline explosion in British Columbia that really highlighted the reliance on Canadian natural gas in that part of the country. We saw unexpectedly a lot of volatility start to show up, and again, a price spike at the soonest point in Washington to as high as $160 per MMBTU earlier this year. And because the West Coast is the most volatile, and we've seen the most interesting price action and dynamics there. I wanted to highlight that a little bit. These next couple of slides focuses on California, specifically PG&E and the SoCal Citygate, where we've seen more volatility in natural gas pricing here, both last summer and throughout the course of last winter than we have pretty much anywhere across the country on a consistent basis. And again, this is due to that ongoing pipeline maintenance and very real deliverability issues where near-term demand is tough to meet in a lot of cases when you see weather-related load spike like we saw last summer and like we saw a couple of times over the course of the winter. But even that volatility pales in comparison to what we saw at Summit. So you've got a couple of different spikes here. One is immediately following the pipeline explosion in late October, early November, where that got up to about $60. And then you saw subsequent volatility as things got really cold again amid some ongoing maintenance in the Pacific Northwest during the first quarter of the year. Things have largely settled down, largely because weather-related demand has cooperated in recent months. We're coming up on a summer where if we get any major heat waves along the West Coast, we are still subject to this type of volatility. The issues that led to this over the past year are still very much active. And while you can't forecast a pipeline explosion, you can engage in long-term planning that helps isolate your university from the impact of unexpected factors like that. And then the other side of the spectrum, sorry, Chris, go ahead.
Andy, if we could just jump in real quick on that last slide, if you would. There has been some universities who've gone ahead and built their own gas pipeline to ship it in to reduce transportation costs. What's your feeling on that? Because there has been some stories like British Columbia. There was a major explosion in California several years ago on a gas pipeline. But what's your thoughts on universities building and natural gas line coming into their campus to reduce transportation costs?
I think there's a lot of factors, and we'd have to look at specific situations as far as what kind of a cost that would incur. But just from a general standpoint, I think it's a really smart move right now to reduce your reliance on the utility, cut down the transportation portion, because a lot of times these utilities have ongoing costs that they need to recuperate. And even though natural gas is traded and purchased mostly on the open market by institutions like universities, they're still beholden to the utility for that transportation component. And the more you can isolate yourself from that and kind of take control over a larger number of components of that overall cost, I think the better. But like I said, a lot of things to consider as far as the upfront cost, what the specific situation with your utility is. But generally, I do think that's worth exploring.
Thank you.
So running out of time here, but I wanted to show the other side of the spectrum, and this is the Southwest, El Paso, Permian, and Waha. For a long time, both of these points were trading at a deep discount to NYMEX, largely below $2. But since the beginning of the year, we've seen several stretches where they've turned negative. A lot of times when we talk about negative basis or negative pricing, it means negative basis, that it's at a discount to the benchmark. But in this case, we actually saw prices turn negative at these points where if you consume natural gas, you were being paid to do so. So this is not something that we expect to continue for the long term, but there's no immediate end to this bottleneck. We're relying again on pipeline capacity coming online amid a very uncertain situation in Mexico, and then some longer term pipeline projects that are targeted online later this year, the earliest, more realistically, probably 2020, that are expected to flow east to west or west to east across Texas toward the Gulf Coast. That could relieve some of this and lead prices to move higher. But for now, we expect very cheap to periodically negative pipeline or negative prices to persist along that El Paso pipeline. So key takeaways: prices are generally low across the forward curve and across the country. But as we've talked about, low prices do not mean the risk is gone. Quite the contrary. On a percentage basis, you could see your costs skyrocket overnight if things go sour due to a number of different factors. So it is very important to have a risk management plan to establish a healthy position, locking in prices into the future. And this happens to be probably the most attractive market to be planning for the long term and that we've ever seen. So it is very important to tailor a risk management strategy to your specific university and your specific situation to best take advantage of the opportunity that's out there on the table right now. And I believe that's all I've got, unless there's any outstanding questions. That's it for
Andy,
me.
we do have a few questions. Thank you very much. And we know this is an important topic because everybody has stayed on the line. And so we have several folks, Arthur, Brian Johnson, Dave Meharry, Ian, Ted, Tim. We want to give everybody a shout out through APA. John Garlitz has asked a question. If the regional drivers can affect daily prices from free, and again, I'd like to see the free one, free to $1 or $159, which I experienced 3 days in March, the national demand and storage numbers are not as meaningful as a region. Can you comment on that?
Sorry, Chris, could you repeat that one more time? There's a little bit of breakup there in the middle.
Yeah. Basically, what John is saying is that if the regional drivers can affect the daily prices in such a dramatic way, which he experienced, then the national demand and storage numbers are not as meaningful on a regional level.
I think that's partially true, especially when you look at the spikes that you see in day-ahead markets. They are very much more driven by what's going on specific to that region. But when you're looking at forward pricing and the way that the futures prices trade, they're still directionally at least driven by what's going on at a national level and what's going on with NYMEX. So I definitely see where that question is coming from, and the regional specific risk is very important and perhaps more important in a lot of cases, but a rising or falling tide will tend to lift off ships, and NYMEX is still the primary component of most supply agreements across the country. So if we see a spike like we saw last November at NYMEX up to $5, that's going to have an impact regionally, but it's going to have a widespread impact across the entire U.S. with a lot of supply contracts being impacted by that large NYMEX settlement.
We have several more questions. We're not going to have enough time, but this is more on a sustainability question and a greenhouse gas. And so Tib Dobson there in New Mexico, when we're looking at reducing our greenhouse gas emissions, and that's what we're producing on our campuses, Scope 1, or what we're buying from our local utility provider, Scope 2. You showed a chart here that showed coal is decreasing over the years, gas consumption is increasing, but there's still an emission concern with that, with our cogeneration systems at some of our universities. What is your take looking ahead as solar and wind becomes, that percentage is also increasing?
I'm not an expert on renewable generation. We do have an entire department devoted to that I'm in touch with but not part of. But my take is that we will continue to see investment in wind and solar. And if you look at this generation mix specifically to California, for instance, which I can actually show here, I've got it on a different slide deck. Bear with me here for just a second. So this is the California generation mix, and solar has reached 14% of this. Wind is about 7 or 8% of the mix in California, but natural gas is still the lion's share. And what the important thing to keep in mind, at least until we see any major leaps in battery technology or the ability to somehow store power that's generated during the day to be used around the clock, we still need a baseload fuel. And I think until again, unless we see any big changes in technology, which I don't discount the possibility of, I don't think that we know everything right now. We certainly don't. But natural gas looks to be the cleanest source of energy to service that base load generation. Definitely more clean than coal. Not as clean as nuclear, but there's not really an appetite for new investment in nuclear generation right now. So I think that you'll continue to see renewables make up a larger share of the mix as that investment comes in, especially in states that have a mandatory renewable portfolio standard like California. But I don't think that you'll see any meaningful dent put in the natural gas share of the mix from renewables for at least the next 5 or 6 years. I think that those incremental increases in renewable will kind of offset coal before they offset natural gas, because coal is still a major part of the generation mix in the U.S. And there's still a long way to go before we even get that reduced to the point that it's no longer such a big factor. So I think that you would still expect to see natural gas share of the mix increase for at least the next 5 or 6 years and probably beyond.
Well, Andy, we've run out of time here, and we have questions still coming in regarding the consumption, increase in gas consumption, infrastructure questions or constraints, but we'll have to cover those in the future. Any final comments?
Nothing for me. Just thanks everybody for the time today. Really appreciate it. If you've got any interest in having any sort of conversation about this on a more specific type of a basis, please reach out to Chris. He knows how to get a hold of us.
Well, Andy, I want to thank you. Kinect has been an outstanding partner of APA for a number of years now. This has been an outstanding topic based on the number of folks we have and knowing all these. These are the key decision makers who have to buy natural gas, and they're looking to make sure we're getting those in a very cost-effective manner. So this topic was outstanding. As APA continues with our continuous learning model, APA just has great topics, and our business partners supply us outstanding cutting-edge topics, keeping us, our facilities leaders, on top of the curve. In the next couple of months, we're going to be having Belfour come in as we're coming into and we've already come in, unfortunately, in some areas, tornadoes and hurricane weather season over the summer. We're going to have GLHN on here also, and they'll be talking about the fourth industrial revolution and harnessing that big data to make great operating decisions. We'll be talking about water conservation measures over the next several months too. So again, Andy, we want to thank you very much. This will be available on our webpage in the next day, if not later today. Billy does an outstanding job. Please go to APA's webpage, take a look at future webinars, and the PDF and the audio will be on there. And remember, you get a CEU. And so, Andy, thank you very much. We appreciate your time, your expertise, and all your willingness to share with our members. And APA, thank you very much. Have a great summer, everybody. Thank you.
Thank you, Chris.
Goodbye.